Today's CPI print lighter than expected, though muddied a bit by the government shutdown. Goldman's chief economist, Jan Hatzius, is here at Post 9 with what it means for the economy and, of course, for the Fed. It's nice to see you again. Welcome back.
Great to see you, Scott.
Do you believe the 2.7 is real? Because there seems some question because of the shutdown.
There are some questions around the shelter numbers in particular, and there is more uncertainty, of course. So I would discount some of this. I mean, we had 8 basis points on average for core CPI in October and November. That's probably a downside outlier. The more important aspect, though, is that we've now seen core inflation go basically sideways, maybe even sideways to down a bit on a year-on-year basis in 2025, with a significant amount of tariff pass-through. That means underneath that, the underlying trends are still improving. That's important.
Okay, so the most important number between 2.7 inflation, 4.6 unemployment. How do you see those?
That's a really hard one to answer. I think they're both very important. The important point from a Fed policy perspective is that they're pointing in the same direction, because the 2.7 is a little bit better than expected. It is consistent with disinflation underneath the surface. And the 4.6 is a little worse. So at this point, at least if you look at the recent changes, the two sides of the Fed's mandate are pointing towards some additional cuts. And we have a couple more cuts.
We do have a couple more cuts. You think in 26 we have a couple?
We have 2 more. We don't have a cut in January at the moment, but I think I want to look very closely at the next employment report. If that confirms upward pressure on the unemployment rate, then I think January is a possibility. Right now, I would say they wait until March.
Okay. Why shouldn't they cut in January if this number, 2.7 on CPI, is believable enough and 4.6 is concerning enough? Why can't they go?
It makes sense to me. I think there's a good case for going in January, but we just had a meeting and they set a higher bar. And in terms of what they're likely to do right now, I would say they probably wait a little bit longer. But it's becoming a closer call.
Well, is part of the problem that the Fed itself is so divided that getting to the end game of the actual decision is harder to come by?
That's definitely part of it, although in the end, it's still the leadership that ultimately drives the decisions. So if Jay Powell and the leadership got to the point where they said, we really want to go, we think it's the right thing to do in January, then it would happen.
If we were to say, well, the Fed is cutting into what looks to be a strengthening economy in 26, does that work for you? Are you worried about the prospects of that?
I'm not really worried about it, because the labor market looks like it's going to be a bit on the soft side, even with a pickup in GDP growth. And we're on the optimistic side with GDP growth in 2026. We have 2.6% annual average growth, but nevertheless think that the unemployment rate probably goes sideways here, and that means inflation risk, I think, is diminishing.